Kelly, I just want to ask both of our guests one question, which is the stock market whistling past the graveyard, or is the bond market heading prematurely for the bunker? and by that, I mean this. If you look at, for example, the January 2025 Fed funds contract, 125 built in through January.
Wow.
Go further out, 200 basis points built in.
So we're going from 5.5 to 3.5 on.
So, okay, I'm putting words in the minds of the market, but do you see the Fed cutting 200 basis points in the absence of a recession? And if that's what the bond market is looking at, is the stock market ignoring what the bond market is afraid of?
Michael, you first.
Sure, happy to do it. So when you think about, Steve, Fed easing cycles really since the 1980s, the average Fed move in the first 12 months of a cycle is about 260 basis points. So yes, today it's priced for 200. Could that happen? Sure. And why? The reason is that real yields are still very high. Think about real Fed funds. Fed funds now is 530 and change. Inflation, depending on how you measure it, if you look at the more short-term measures, below 2%. Real yield is above 3. That's way too high. So that tells me, yes, the Fed could come in and cut 200 basis points, even if the world's not falling apart. And I would go on a bit further and say, if you look out to the very distant pricing contracts, they'll tell you the Fed stops around 3. That sounds too high to us. So I think there's plenty of room for the Fed to go, even barring some kind of calamity.
Although, Steve, I take your point. I mean, the mid-cycle adjustment cuts are usually much shallower than the ones that accompany a deep recession and a financial crisis.
I think we have to look at a median on that, on that 260. Like, what is the 260? Does that include the, for example, the 2008 great financial crisis? So it's an interesting point. But what he's saying is that that scenario can happen with David's the economy is going to be okay here scenario.
And David, I'll give you a quick last word on that if you want to address that same question of how deep the cuts could go and why.
So we don't know that the cuts are going to be that deep, maybe 1.5%, but we think the economy's okay. When the Fed's lowering rates, inflation's going lower, and earnings are there, it's a good environment for stocks. So we think the stock market has it right. And maybe bonds, we would not be buying long bonds at this point. Short bonds yields will be going lower.
I don't want to insult Michael because he comes from the bond, if I'm not mistaken. But, you know, people say they're not smarter than the rest of us. They're not the brainy kids that I don't know. We'll see what the next couple of years bring.